Hi, I'm Keith McCullough, and welcome back to the Investing Summit. Hope you enjoyed that conversation I had with Dan. We focused mainly, at the end there on Japan and gold and all the different asset allocation decisions that you can make. On this conversation, which I tend to have some of my best, one of my faves for the Investing Summit, Lizanne Sonders, I'll focus more so on U.S. dollars, U.S. equities, but if you want to go there, Lizanne, we can go wherever you want.
Sounds good. Always love being here, Keith.
Well, thanks. And I said to Dan, I said, look, Lizanne might be upset with me because she usually leads off. And there's nothing to read into that. So I said,
okay. I'm not insulted. I couldn't have been the lead off anyway. So I had more important things on my schedule, but thank you.
Well, I appreciate that. I told Dan what I told Dan. But let's just get into it. I want to get into the rate cut or not rate cut. We go back and forth, flipping around. We can show it in different pictures and slides, but never in our careers has that flipped around so much. Mainly because we've not gone from A to B and towards whatever C is going to be. I don't think at all, with inflation staying higher for longer. So, just want to get your thoughts on that and how the equity market in particular is trying to read it.
Well, arguably, there's been a tendency by the market in terms of positioning to get a little bit over its skis with regard to future assumptions around Fed policy. I mean, that was to an extreme at the beginning of the year when the assumption was that the Fed would start cutting in March and cut up to 7 times. And we were certainly on record saying that made no sense based on the backdrop of either side of the Fed's dual mandate. And once you got the sort of the short-term turn back up in the inflation data, of course, Powell had to come out, as did other speakers, and push back on that narrative. And they've had to do that a little bit recently. And I think the extrapolation of the decision to go 50 at the outset into 50 basis point increments didn't make a lot of sense. And then, of course, we got the exclamation point on that perspective with the stronger than expected jobs report. So we've taken 50 off the table. I looked just before we came on, I think it was about 88% probability of 25 basis points, which leaves 12% probability the Fed does nothing. But we've got a lot of data between now and then. We've got several inflation reports this week, CPI, PPI. We've got another jobs report. And to your point, Keith, I think the probabilities are likely to still jump around. That's the thing about data dependency on the part of the Fed, is the data will lead to changing expectations for near-term Fed policy.
Well, what people, what the street, I'll affectionately call the old wall, really wants is they want it to be the beginning of a long interest rate cutting cycle. That's you can see that in the lens of what you just walked through. Maybe not everybody saw it that way, but it certainly happened. And you being as empirically driven as you are and fact-based as you are, I can fact check you. So we got on slide 46 just to show a picture on what Lizanne said. Like at the beginning of the year, I didn't either. You buy into all these rate cuts. I think at one point there were like 8 or 10 of them priced in. So on the left side, we're showing this, what we call the pendulum of expectations on rate cuts. Then they took them all out, and then they put, then we actually saw inflation go up, obviously from January to April. Only 40 basis points, Lizanne, but that took out all the cuts.
Yep.
And then let's go right back to where we've always wanted to be, cowbell. And now we're having a problem with how much cowbell. So we're going to have like a fourth picture there, I guess. Whether or not, I have my answer on this, but do you think they overshot on how many rate cuts after the 50 basis point? At one point, they were pricing in 50 for the November meeting.
Well, it certainly looks like that now based on the data that we have in hand. But again, that could change. I think the real point, and Keith, you mentioned it in terms of what the market has been hoping for, that we would be at the start of a lengthy cutting cycle. But we've been cautioning investors with a sort of couched in be careful what you wish for if you're hoping for a Fed that continue to be aggressive in rate cuts, sort of eyeing the elevator down, not the escalator down. Because if there's one way to differentiate past Fed cycles, the cutting part of the cycles, is fast versus slow cycles or aggressive versus less aggressive cycles. And that's where you run into a more consistent distinction, is if you look at things like average maximum drawdown within, say, 6 to 12 months after the initial cut. The fast cutting cycles, the maximum drawdown has been more than twice as much as in the slow cutting cycle. So all else equal, you actually want a Fed that is not approaching this like, okay, open the elevator, we're gonna jam rates down, because at least based on history, an aggressive cutting cycle is usually because they're trying to combat a recession or a financial crisis or some combination thereof. So this shift to a more methodical Fed, I don't think is a bad thing for the equity market, all else equal, which that's an important emphasis.
Yeah, you're exercising your own inner Danny Kahneman there, like cutting fast and cutting slow. I mean, it's like that. Yeah, that's the point. Like if you're panic cutting, that means the economy is something you should be panicking about. And if you're cutting slow, well, in this case, you could cut slowly, and then, like I always say, risk happens slowly and all at once. But in this case, you could cut quickly, then slowly, then not at all. I mean, if we're right on inflation, and clearly we have a differentiated view on that versus the Atlanta Fed or whoever's trying to nowcast whatever at this point. But the Fed guys, show slide 26. They're trying to say that the inflation is going to go to the target, 2%, and we're saying this CPI number on Thursday is going to be the low print for the monthlies, and then the quarterlies are going to start going up again in the fourth quarter and then again into the first. You can tell me if you agree or not on that, but if I'm right on that, what do you think Fed policy will be?
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
So I'm not sure if you're right. I don't know. So I'd love to be able to forecast inflation. This would make my job a lot easier. But I think, to me, the important sort of force underway within the inflation data, whether it's in CPI data, less or so in PPI data, but PCE data, is the widespread between what we used to think of as sort of goods versus services inflation back in the earlier part of the pandemic. Now I think the more relevant breakdown within a metric like CPI is discretionary versus non-discretionary components, which somewhat fit within that goods versus services categorization. But if you break CPI into the discretionary versus non-discretionary components, thought in more simple terms as the wants versus needs components, you've wiped out all the inflation in the discretionary components. You're running at about a zero level. Now that's before this week's update to CPI, obviously, where you're down on the non-discretionary components, but you're still up in the 4 or 5% range, whether it's insurance or healthcare related costs. And I think by nature of what they are, they tend to be a bit stickier. And the lever that the Fed pulls with monetary policy, either with the Fed funds rate or the balance sheet, is not going to go a long way, if at all, to bring in something like auto insurance costs. So I think that's an important way to look at the inflation data in terms of, where the sticky components are versus the components that are driven more by what's going on in the trajectory of the economy. So that's one of the things that I'll be looking for when we get the data this week is what that breakdown is between wants and needs.
Yeah, there's a lot there. There's also shelter. Shelter, which is a third of the CPI, didn't go down as much as the doves would have told you it would with interest rates going up, not even close. That's at 5%, right? So a third is at 5%, and if base effects matter, starting like in T-minus really 3 to 6 months, shelter is going to be additive, as it has been on a cumulative basis going back since inflation took off 3 years ago. What do you think about that? It seems that people tend to focus on what was already reported yesterday, but that, to me, I'm from the future, Lizanne.
Yeah, so certainly within a CPI metric where you've got that owner's equivalent rent portion that is a much, much larger share of CPI than, say, the shelter components are as part of PCE. And of course, PCE is the Fed's preferred measure. But you're right. We have not seen what was the expected turn down in those shelter components in CPI. They did not, or at least not yet, have followed those real economy rent measures from the likes of, Zillow or RealPage or apartment lists. They have been stickier on the high side. I don't love how much an OER weight exists in CPI. It's an imputed rent. It requires, respondents to the survey to guess what their home would rent for. So it's a little wonky, and I'm not sure really based in that much reality, but it is, and it is what it is, and it's apples to apples at least over time, and it has been stickier on the high side. To your other point, now I'm going to talk about this slightly more broadly with regard to moves up and down in interest rates, and maybe the muted impact it's having on areas of the economy that it's had a more direct and shorter term impact in the past, has to do with some of the behavior that was put forth by at least two major constituents within the economy, corporate America and households, during the ZIRP environment that preceded the most aggressive tightening cycle in 40 years. And you saw it with large corporations in terming out debt. You saw it in the mortgage market when mortgage rates were at a high with an 8 handle on it. The average effective mortgage rate didn't even have a 4 handle on it. So that's not to say the impact of monetary policy is gone in this cycle. It's just been muted by some of the maybe intelligent decisions that were made by some constituents, leaving the government aside because they didn't do as much as they probably should have done in that ZIRP environment. But I think that has sort of elongated this long and variable lags, which, by the way, certainly was the case during and in the aftermath of the tightening cycle. I also wonder whether we shouldn't make assumptions about a quick impact on the economy from an easing cycle, because some of those forces are still in play, just in the opposite direction.
Yeah, that's and there's always so many things in play, and I love how you do macro, obviously, in strategy, because you incorporate everything. You don't anchor on one thing. Like, right. I think anchoring on core PCE is ridiculous. At one point the doves are, well, what if you look at the 3-month rolling PCE? Well, once the 3-month rolling PCE rolls up your ears, like starting like in T-minus 2 months, you're not going to use that anymore. So right. That's called data mining. Obviously, you know
well,
that.
Well, it's not just data mining, but you and I live in the minutia. As analysts and strategists, we're focused on month over month versus year over year, and core versus headline, and core services ex housing, and the differential between CPI and PPI and PCE. Here's the bottom line as it relates to sort of infiltrating into the economy and the psyche of investors, consumers, is that's not the world they're living in. They're living in the world of stuff is a lot more expensive than it was pre-pandemic, period.
Yeah, big time.
Period. That's how they think of it. They think in level terms, as opposed to the minutia of the month over month changes. And that's why inflation, the NFIB report that came out today, no surprise, inflation is still the #1 cause of concern. And that's in part because customers, individuals, households still see it as a big negative because they're not focused on rate of change like we are.
And they're not focused on monetary policy like they are.
Right.
Wall Street is focused on their own language, their own data mining, their own way to get to the cowbell. That's the point. And if you can't get any more cowbell, the bond market just had a hell of a move in volatility terms in the last couple of days when it came to realize that a 15, 17, 18% rise in crude oil prices to join every other commodity that's breaking out post the Fed cut is the real world. Like, I can't find in rate of change terms from the minute that the Fed cut rates, actually was commodity markets were front running before that, obviously, but let's just say in the last month, double-digit increases in everything from milk prices to basically the entire food complex to now oil prices. That for somebody who does, my job is to nowcast inflation, those go directly to the vein and into the model, Lizanne, and those things, I can't for the life of me, against easing base effects, predict a down inflation environment.
Right. Well, especially at the headline level, to your point about commodity prices, but in particular oil prices, which obviously have been driven by what's going on in the world of geopolitics and wars. And that's that's not a force that any of us can either anticipate, forecast in terms of longevity and magnitude. And it's certainly not anything that the levers that the Federal Reserve can pull or other global central banks really can have much control over. And even though we can focus on the fact that those are feeders into headline inflation, not core inflation, there are still ripple effects, not just within the inflation data, but again, into sort of the psyche of households and consumers and businesses, which then brings in the animal spirits part of any economic conversation, which is such an important driver.
Yeah, and of the bond market. I mean, like, I get that people want to talk about core, but the bond market trades on headline, year-over-year trending CPI. That's it. That's why I use it. I don't use it because I don't want to be intellectual. I'm not an intellectual. Actually, I don't want to be one. But the a couple points just to show you on what Lizanne said on the nonsense of it all, like Wall Street speak, or the CPI for that matter. On slide 95, we show what she called OER, right? Owner's equivalent rent. But again, I agree. It's like not a practical thing to describe it that way, but it is base effects. That's what that chart is. It's base effects, right? So I'm just trying to remind people of that. And then this other big thing, Lizanne, I wonder if you have thoughts on slide 91, which, what interest rates really did impact was multifamily. Okay, so construction, right? Like if you're a lot of mom and pops, or again, small businesses, construction, however many crews they have, you saw a tremendous drop off in the supply of the one thing you need to solve for an immigration number that has been fake news.
Oh, yeah, no, absolutely agree. That's clearly where you saw the biggest surge in supply. And I think there's lots of forces that cause that supply to come down. And the problem is the other supply problem has been outside of multifamily and single family in the existing home market because of that differential between stated mortgage rates and actual mortgage rates. And basically that locked a lot of existing homeowners into their homes, even if they wanted to move, to go from an 8% or 3% mortgage to an 8% mortgage was just untenable. So we are now dealing with, further supply problems. You're seeing a little bit of maybe loosening it up. You're seeing, increase in mortgage refinancings, but a Fed that puts the brakes, at least temporarily, on aggressive rate cuts, then that changes that narrative a little bit. The other thing I wanted to mention as it relates to the move up in yields is for quite some time in this recent cycle, the post-COVID cycle, you shifted to a pre-Great Moderation correlation that went in negative territory between bond yields and stock prices. But that was during the era within this cycle where inflation was top of mind and yields were driven both up and down based on trends in inflation. The more recent period where we've now seen a move to a positive correlation between yields and stock prices has been this backdrop of yields moving more based on the growth outlook and less based on the inflation outlook. I think that's an important point we sit right now, because let's assume you're right and inflation based for base effects and other reasons starts to tick back higher again. If you reconnect bond yields to inflation and that becomes the short-term driver, it wouldn't surprise me to see that correlation move, maybe not firmly back into negative territory, but maybe away from that positive territory. So I think is it the growth side of the equation that yields are keying off of, or the inflation side of the equation? I think that has important implications for how equities behave in that kind of backdrop.
Well, if you take, very well put. I mean, I've always thought of Fed policy as a three-legged stool. Where's inflation, where's employment, where's the S&P 500? On that last one, that's not a joke. I mean, again, he cut by 50 basis points after the NASDAQ went down double digits in what we call quad 4. Economic data was terrible throughout the entirety of Q3, with the NFIB numbers coming out for September today, just putting an exclamation point on that. But it did what it did, and now you got to deal with both, as opposed to forever and a day. It wasn't a healthy labor market in rate of change terms, to be clear, which we can show if people still don't know that. Labor peaked, as you know, across all metrics at the peak of the cycle in 2021. So you can look at anything from temp staffing to hours worked to any component of jobs, and they'd been deteriorating. It just so happens that the Fed didn't talk about that leg of the stool. So
you and I agree on a lot, but I don't want to take the other side of the NASDAQ 100 being down was a prompt for the Fed to go 50. I think the Fed put is still very much alive, but as it relates to economic data. And I think what they were really keying off of, number one, somewhat simplistically, is just because inflation had come down, real interest rates were seen as too high. I think they probably should have been more focused on broader financial conditions that continue to be pretty loose and maybe didn't justify 50. But I think it was some of those concerns creeping in what they view to be the leading indicators associated with further weakness in the labor market, the hires rate having come down, even though we weren't seeing it in claims. So I think the labor market is not the sole driver of what the Fed has done and will continue to do, but I don't put a lot of emphasis on short-term moves in the market, leaving their dual mandate aside as a driver for Fed decision making. I think it's really these days about the labor market and their views thereof.
Yeah, I obviously think what I think on that. I mean, if the S&P 500 didn't go down 20% during Quad 4 and Q4 18 when Powell was a rookie on the job, would he have gone dovish?
Oh, I think at that time there was absolutely a Fed put associated with the market. I just don't think that it's as robust a factor at this point. In fact, even in 2018, one of the more interesting things that Powell said at that somewhat famous, infamous New York Economic Club lunch, and I was there in person, and I thought his sort of body language and emphasis was interesting. He said that the Fed is not going to operate monetary policy based on volatility in the financial markets. It operates based on stability in the financial system. Only if volatility in the equity market threatens stability in the financial system. But separate from that, just simple volatility or weakness in the equity market that doesn't have feeders into the health of the financial system, I think that's the important differentiator. And I think there was concern at the end of 2018 that there was that connection. I think just weakness in the equity market right now, absent commensurate deterioration in the mandates, I don't think will be a trigger for further rate cuts.
But I hear you, but we're old enough to remember August 5th when the VIX went from 6 to 65. Like, I don't think that looked like a stable situation to my buddy P.E. Powell.
No, but that was also the unwind of the yen carry trade and concerns about the infiltration into the global financial system. That wasn't just a market event. That was something maybe not potentially very systemic, but that intraday record spike in the VIX, which, by the way, the same day you had a record intraday decline in the VIX. So talk about a whipsaw on an intraday basis. But I think if you're sort of aligning Fed policy to that moment or what was a driver there, it was more than just a market-related spike in volatility. There was that yen carry trade unwind and how much more afield could this go, and what kind of global financial system damage could be underlying this start to the yen carry trade unwind?
Yeah, I 100% agree on that factor. Dan Rasmussen and I actually discussed that in the prior conversation. But you can't just, it's not a vacuum, right? I mean, it wasn't just yen carry trade. It's the BOJ was getting tighter, the Fed was getting easier. This hasn't happened in our career, and this is new. So it creates what we obviously call conditional factoring that was making the situation riskier. So I think it's going to be really interesting with 0 days to expiration options trading becoming the bubble that it's become. What also happened that morning was that all the dealers just said, I'm out of here. This bid-ask spread's too wide. So you have a central part of the market structure. The dealers just walked away. And this is all, I think, on the Fed's clock. I mean, you can't print $22 trillion and say that you don't have, this is due to supply shortages and yen carry trades. I mean, it's all, to me, this is still all, market structure is all on Powell's watch. And I don't know how he's going to get away from it, but I think creating like this volatility, again, the move index yesterday had its biggest move since 2020, right? That's Treasury bond volatility. So that, you guys can show the chart. I mean, since 2020, Lizanne, like that's showing you how all over the place people actually are about my point at the beginning, which is people just want their cowbell in a rate cut cycle that goes, to rainbows and puppy dog land. But if they don't get it,
I think there's another reason for the spike we're seeing in volatility in the MOVE index in the bond market, the VIX back up north of 21. We're now within that 30-day span to something I believe is happening in early November that may be leading to some uncertainty. So there may be an important reference point to highest since 2020, because that was the last time we were in a presidential election term. And I think that's also a reason why you saw, even though the NFIB overall optimism index actually ticked up a little bit, you saw a massive spike in the uncertainty index. So it's almost like small businesses are saying, we're feeling a little better. We're just not at all certain about the fact that we're feeling a little bit better. And so I think that now, in addition to all the uncertainties we've talked about with regard to inflation in the labor market, clearly one of them that is more front and center right now is what's happening in a month from now.
And this is a good way to segue into the dollar. I mean, the dollar is, it's the fulcrum point of everything that I model. If people want to disagree with that, that's fine, but that's my model. It's also the world's reserve currency, so that one's a little tougher to debate. We have plenty of data to support that the dollar should be, if you're locked in a dark room with no other quote, the one thing that you should be paying attention to. I know you have thoughts on that status. I think the reserve currency status being.
I don't think the dollar's losing its reserve currency status anytime soon. Probably not in my lifetime. Now, that's not the same thing as saying that there's diversification away from the dollar. And in the case of a country like Japan, they've been diversifying away from the dollar for about a dozen years now. So that's not some brand new story, but there's really no replacement for the dollar as the world's reserve currency. You still have close to 80% of global trade done in dollars. You've got to have a place to put that money after trades, and there's nothing that rivals the size and scope and liquidity of the U.S. Treasury market. There's ample demand for treasuries at this point, so we don't view there to be some sort of moment in time tipping point. That's not to say that having a high and rising burden of debt is nothing to see here and whistling past the graveyard. It's a significant problem, but I don't translate that back into some moment in time crisis for the dollar. What the fundamental in the short term that drives currency moves is obviously interest rate differentials, and that of late obviously has been a moving target, back to the point, as you mentioned, where Bank of Japan surprised with the start of rate hikes, and that was at a point where the Fed wasn't cutting, so that differential narrowed. Now we've got this moving target as it relates to what the Fed is going to do. But you also have currencies that are being traded more, not just by the institutional world and traditional currency traders, but even individual investors. And what that brings into the mix is you can see swings, and that you could say the same thing about an area like commodities. You can see swings that maybe aren't as easily defined by the traditional fundamental supply and demand in the case of commodities, or interest rate differential in the case of currencies, and you can get sentiment-based swings and momentum-based swings. So I think that sentiment analysis and the overbought, oversold analysis has to come into play when you're analyzing something like currency markets, in addition to the traditional fundamentals that drive those moves.
Yeah, if you guys can show the global currency volatility chart, I mean, it's clearly upward sloping since the Fed decided to go that way. And it's not just the BOJ, right? And the Bank of England, in the same week that the U.S. cut by 50 basis points, stayed on hold. So it's a very interesting time. I mean, the U.K., of course, is coming out of a recession. The debate in the U.S., are you entering a recession? I'm not of the view that we're entering a recession, but there's a lot going on, I think, is your point, and I certainly agree with that.
And I think the bifurcations within the U.S. economy are more acute than in other parts of the world. We've talked about it on this program several times, Keith, over the past several years, of sort of the rolling nature of this cycle. The surge in growth during the stimulus era, the early part of the pandemic when things were still locked down, had the effect of boosting growth, but with a concentration on the goods side of the economy because services were completely shut down. That was the breeding ground of the inflation problem that obviously accelerated significantly into 2022, but largely on the goods side in terms of categorization of inflation. But then we actually went into hard landings, recessions, sectoral recessions in manufacturing and housing related, and some of the stay-at-home beneficiaries in the consumer area, the Pelotons of the world, and Zoom equipment and Lululemon. But we had the offsetting and later strength on the services side. The roll through has happened in the inflation data. So I think the recession versus no recession, or recession versus soft landing, sort of misses the nuances of this cycle, given that we have had hard landings, certainly in the interest rate sensitive segments of the economy. And it helps to explain why, an indicator, a set of indicators like the LEI, the leading economic index, has sort of missed the boat, because the economic components of the LEI are manufacturing oriented. That's not really because the folks at the Conference Board are completely clueless and they don't understand that services is a larger driver of the economy. It's just normally weakness shows up in the financial components first, an inversion of the yield curve, typically weakness in the equity market. Then you start to see it show up in the economy and the leading indicators, manufacturing, new orders, and then it eventually takes the services side down with it, but with a somewhat limited span of time as you roll through that. This cycle has just upended that. And whether or not we've broken that relationship between weakness in services morphing into weaknesses in manufacturing into services, or whether we've just really elongated by virtue of the unique characteristics of this COVID cycle, I think it's too soon to tell at this point. But I think some of the debates around recession versus no recession are almost a little bit too simplistic, because it misses the point that we have had sectoral recessions and arguably haven't quite come out of them yet in terms of areas like manufacturing or housing.
So you put it so politely. They're too simplistic. I'd have other words for that, like fake news, lies. It's like you're the first person, I believe, at least to my ears, who coined the term rolling recessions. I mean, it was a reported
Denny and I battle for supremacy in terms of who used that terminology first, but we were both pretty early in using that to reference the unique nature of this cycle. And I've gotten a lot of criticism for that. Oh, that's a terrible term, and well, I don't care. Come up with another term. But what it describes has actually happened. That's not just my opinion. It actually has happened. So if you have a quippier term than rolling recession and rolling recoveries, have at it. I just, that's my term and I'm sticking with it.
Good, because what we've done in this country in particular is we've gone from actually having intelligent discussions, provided that you and I are having the conversation, of course, but having like objective, intelligent, data-driven discussions to making it too simplistic, and I'd say borderline dumb. Like you hear people say some really dumb shit when it comes to things that are empirically not true, right? But they need to believe it. They want to believe it. That's the fourth turning. That's the political environment we're in. So we got to deal with it. But I mean, if we call this, I actually asked Drago, one of my senior guys, this on the call this morning. We let people listen in on our research meeting, and I said, Drago, at what point, and do you remember ever anyone, any traditional establishment Federal Reserve economist, actually plainly stating that we have a K-shaped economy depending on what your income is? And he's like, no, never. Why? Like,
but it's actually what you see in the data. That was certainly the case in the early part of the pandemic. You're still seeing it. Even very common, widely followed metric like consumer confidence. The Conference Board doesn't just do the headline index and the questions that feed into that, but they break it into confidence. Into income levels, into 4 income levels. And the only income bracket where confidence has been rising, maybe no surprise, is the highest income bracket. All the other 3 of the 4 that they categorize, confidence has been declining. It goes back to the needs versus wants categorization within inflation. Obviously, when it's the needs components that still have the elevated inflation, that hits lower income folks more, because it's a greater portion of their take home. So the most important tool I think we all need to have handy when analyzing all of this stuff, maybe always, but certainly in this cycle, is the fine-tooth comb. And there's an attempt to be overly simplistic and focus on headline data, but the real story is told under the surface. And that's not just in terms of the economic data. That's in terms of the market data. For all the discussion about the resilience of the market this year and limited maximum drawdowns at the index level, certainly for the S&P, which hasn't had a 10% correction, you did in the NASDAQ. But even now, the average member maximum drawdown within the NASDAQ is 45% year to date, and it's almost 20% year to date for the S&P. So even just to get a true sense of what's going on in the market, you better look below just the surface of these cap-weighted indexes to get a fuller picture of what's been happening. These rotations and the churn under the surface, I think, tells a at least more robust story than what you just pick up if you're only looking at index level changes.
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
I would suggest you all try to get some carbon copy of her fine-tooth combs. And if you don't have those, follow her on Twitter. Every morning, you guys are doing a great. I know you call it teamwork, but you're leading it. It's a huge. That's as opposed to whining or being a political hack on this topic. You're providing a solution. Like, here's the data. Look at it. You can call it whatever you want to call it. I know what I'm going to call it, and I don't care what you think about what I'm going to call it. I love that about you.
And speaking of the election, as you know, Keith, I don't wade into partisan politics. I'm actually a registered independent, so I actually feel like I can be an equal opportunity critic at times, but I don't tend to wade into it. But obviously, a lot of questions we're getting about the election and what it means or has meant for the market. So we put together a report last week that is purely data-based, purely fact-based, no color commentary. Here's the data. It looks at the history of party in power and breakdown in Congress and what the market has done, what the economy has done, and use it if you want. Come up with your own inferences about what it means. But I think it's important to remind people probably the most important thing, which is, when you're in an election year, they're emotional. And clearly this year is emotional. Don't let that cloud your investment decision making. And there's so many beliefs that are just simply not true. One example that I use of that is, we think of Trump as being very pro-traditional energy and Biden/Harris as being very pro-future energy, green energy. We also know that the energy sector in the S&P 500 is all traditional energy companies. There's no solar companies or wind companies. So, and I've seen reports that say, if Trump wins, that is clearly positive for the energy sector based on what we know under his 4 years. And I think you didn't bother to look at the data. So from inauguration day to inauguration day under the Trump administration, there's 11 sectors in the S&P 500. The single worst performing sector was the energy sector. It was down 40% in that 4-year period. It was the only sector down. The next worst sector was up 20%, so a 60 percentage point difference with energy as the worst. Well, fast forward to the Biden-Harris administration, from inauguration day to yesterday's close, energy is by far the best performing sector, up 118%, versus the next best sector, which is tech, up 88%. So, 30 basis point better performance, 30 percentage points better performance. That is not, by the way, because secretly Trump was anti-fossil fuel and anti-traditional energy, nor is it to say that Biden secretly was. It's just so many other forces that impact what the markets do. And it may be the most important exclamation point that we put in this report. It's really simple, but it's kind of a fun one. If you go back to the post-World War II period of time, so 1948, and you invested $10,000 in 1948 and only had it in the S&P 500 when a Republican was in the White House. The $10,000 by the end of last year grew to $311,000. If instead you invested $10,000 and only had it invested when a Democrat was in the White House, it grew to a little more than 1.2 million. There are people, and the people are largely going to be Democrats, that say, see 4 times better performance for the stock market when a Democrat's been in the White House versus Republican. That is true. That's a fact. That's just the math. But if you invested $10,000 in 1948 and you paid no attention to whether the Oval Office was painted red or blue, and you just kept it in the market, you had 38 million at the end of 2023. I don't know about you, Keith. I'm taking the 38 million and letting the 1.2 million and the 300,000 battle it out for some form of, party supremacy.
I love that. Because the whole, and I do feel bad for you that you had to actually go through all that, because that's like, you wouldn't start with that. Like, you're addressing it because clients, and it's a topic, everybody has these feelings, and some are on tilt and others
right.
are.
I don't put a lot of work into the election and proposals and what does that mean for sectors or what the market's going to do, but I get a rash of questions about it. So let's just put it on paper, put it out there and do with it what you will.
Yeah, I mean, and it's not the starting point. I mean, if you were to take, let's just lock me in a dark room and give me one quote, it's going to be the US dollar if you want to have any principal macro orientation on asset allocation, and I mean globally, right? And then you overlay a much more useful or practical analysis, like for people like you and I, would be, where's the US dollar over what period? I mean, one of the biggest reasons why Trump, energy sucked under Trump is because the dollar was strong. The dollar was strong and strengthening, and that is going to make the prices of things in dollars go down. So if we, I think that really is the opportunity for one of these two parties, because they're both really, chronic devaluers of the dollar at this point. That's the one thing that they do have in common, in addition to being like anti-China or something like that. But
they also don't care a lick about the deficit or debt.
Exactly.
They play kick the can down the road really well together, both sides.
It's terrible. I mean, it's terrible. Yeah. Like when you really think about the purchasing power of the people and the real inflation, the cumulative inflation, like you said, it's not just. But
you know what, Keith? I think the investor class cares deeply about debt. I think the average constituent maybe cares about it in the abstract, but they don't vote based on it. And if constituents aren't voting based on it, then they're not going to make the hard decisions. And there won't be adults in the room having, an adult conversation about this.
I mean, I agree. The guys, go to slide 136 and just show the long term, or at least back to, when we started doing this exercise goes on the U.S. dollar. I mean, it's not at an inconsequential point, Lizanne, on that front. The debt is not a trivial matter to analyze, but it's a trivial number. The deficit, we can see that number too. And then you can see, to your point, neither party is going to change it. So if you have that and you're looking for rate cuts, you're at a precarious spot. Like at least on my signal, if the dollar were to break down, back, if we're go, all the way back down to where Bernanke had it twice in 08 and 2011, you have a different outcome. That would be a very stagflationary situation, and one that's already a stagflationary situation for many Americans.
Yeah, and I think one of the most important implications of a high and rising burden of debt, especially if the growth rate in debt is higher than the growth rate in the economy, is that it actually acts as a suppressant on economic growth. And that's not just a US phenomenon, that's a global phenomenon. And that's why I find it odd that when people express grave concerns about the deficit or debt, they translate it into, well, you would expect a massive spike in interest rates and inflation, when the suppressant effect on overall economic growth has actually meant that if you go back over decades and decades and you look at different zones of the growth rate in debt, the higher the rate of growth in debt, the weaker most economic data has been, measured in terms of GDP or job growth, lower productivity. And that has actually brought with it not spikes in inflation, but the opposite, lower levels of inflation. Now, what I don't know is if there is some tipping point. I don't think there is, but I get questions a lot about what if there is a, however you define it, a failed treasury auction, and you see a massive return of the bond vigilantes and interest rates have to go up quite a bit higher in order to entice buyers of US treasuries. That doesn't appear, it's certainly not in place now, it doesn't appear to be in the cards, but that does represent to some degree the Armageddon scenario or the tipping point scenario.
Yeah, the relationship that she just rattled off, just like she would, amongst a lot of things she just said on slide 127, is Reinhardt and Rogoff weren't wrong about that, the relationship between debt and growth. And you can see, obviously, that we're way out there on the lines of a country, not quite Japan or Greece yet, but not exactly in the right spot on that chart. So that's it's a big deal. For me, and it's less so for me. It's I think less so for you. I don't think, given that we're not out of our minds from a YOLO perspective and a risk management perspective, that we're really at risk of losing our wealth. It's more so I'm concerned about my 4 kids and then theirs. How do they, how do they do this? How is this going to go? If we're just going to take this deficit, to where where it's projected to go with no recessions as far as the eye can see, 175% debt to GDP.
We need constituents to care about it, to vote based on it. That would result in, admittedly, tough decisions that have to be made, whether it's on the spending side of the equation or the revenue side of the equation. But shorter term, in an ideal world, you have the growth rate in the economy exceed the growth rate in debt, because then you start chipping away at the problem. And there's just not much incentive, if at all, within Washington to do what needs to be done just to change that relationship between the growth rate in debt and the growth rate in the economy.
Yeah, it'd be nice if they really asked you about this. That's what I think. That would be a really good exercise. I actually had one client in particular say, what I'd like to see. I love it when you have Liz Ann on. I like how she's usually the leadoff. He's a big fan of yours, and he said that. But I'd like to see you guys push and pull at each other a little bit more. And I said,
well, I think we have a couple of times here today.
I think we did on this one.
Yeah.
I mean, you I like it when you push me like that. That was good. We can do this. I think the bigger point here is that we can do this as a country. You're hearing this from a Canadian and an independent voter. We aren't two political hacks. But if you include other people in the room, we can tolerate the debate. We can go back and forth. We can admit when we're right and when we're wrong, and we'll be both. And I think that's just a better way. But that's just me.
And come at it with data and facts. The interpretation of what that means for the future can vary. But when it's based in actual data and facts, I don't know. I'm just spitballing that. I think that's a better way to approach this stuff. But that's just my view.
Well, there we go. We're agreeing with each other again. Thank you. I appreciate it. The one and only Liz Ann Sonders. If you don't follow her, you have to follow her. She's awesome. I'll be up next with an interesting guy that's going to have a lot of interesting things to say, Mark Cohodes.